Trade volume between China and the United States reached approximately $690 billion in the most recent full reporting year, while physical metal delivery registered through U.S.-based commodity exchanges represented only a fraction of global industrial demand. This contrast establishes a measurable imbalance between financial market representation and underlying material flows. The following analysis reconstructs how a single administrative decision alters the mechanical alignment between trade, settlement, and trust within the existing commodity architecture. In late stages of the previous agreement cycle, Chinese authorities formally notified the termination of a bilateral trade and cooperation framework with the United States. The termination was not accompanied by retaliatory tariffs, emergency measures, or rhetorical escalation. It was communicated through procedural language, framed as a non-renewal rather than a rupture. The agreement in question governed specific coordination mechanisms related to trade facilitation, dispute resolution, and sectoral commitments, including references to commodity flows and settlement norms. Its expiration removed a layer of administrative predictability without introducing an immediate replacement. The event was documented through official channels and acknowledged by U.S. institutions as procedurally valid. No extraordinary market closures followed. No emergency liquidity facilities were announced in response. The termination occurred within normal administrative timelines, and markets continued operating without interruption. From an operational perspective, the immediate aftermath was characterized by silence rather than reaction. Clearing systems functioned normally. Futures contracts continued to roll. Physical delivery notices proceeded under existing rules. The absence of visible disruption became the defining feature of the event. This lack of surface volatility created an impression of continuity, suggesting that the agreement itself may not have been structurally essential to daily market operations. Institutional actors publicly reiterated confidence in existing frameworks. Regulatory bodies emphasized resilience. Exchanges highlighted margin adequacy and rule-based governance. On the surface, the system appeared stable, contained, and insulated from bilateral political adjustments. This appearance of normality is not unusual in large administrative systems. Most structural changes do not express themselves immediately. They first manifest as accounting adjustments, legal reinterpretations, or procedural drift. In this case, the removal of the agreement altered no single rule governing commodity exchanges. It changed no margin requirement. It adjusted no delivery specification. What it removed was a coordination layer that had previously reduced uncertainty regarding intent, settlement behavior, and escalation thresholds. The system did not react because it was not designed to react to the absence of intent clarification. It is designed to react to defaults, failures, or formal rule changes. None of those occurred at that moment. The question, then, is not why markets moved, but why they did not. Stability in response to structural subtraction often indicates reliance on inertia rather than balance. Large systems can continue operating under degraded assumptions for extended periods, provided that no single node fails. The continuation of operations does not imply equilibrium. It implies deferred reconciliation. In commodity systems, especially those involving futures markets with physical settlement options, deferred reconciliation accumulates quietly through positioning, inventory classification, and delivery preference shifts. Within this environment, the role of U.S.-based commodity exchanges, particularly those associated with precious metals, occupies a specific functional position. These exchanges are not primary sources of metal. They are mechanisms for price discovery, hedging, and contractual netting. Their stability depends on confidence that paper claims remain loosely tethered to physical availability under extreme conditions. This tether is rarely tested during periods of administrative calm. It is tested when counterparties reassess jurisdictional exposure, settlement reliability, or strategic alignment. The termination of the agreement introduced a subtle but material variable into that assessment process. It did not force immediate repositioning. It altered the long-term calculus of dependency. For Chinese institutions involved in commodity procurement, manufacturing input planning, and reserve management, the agreement had functioned as a signaling mechanism. Its presence reduced the perceived probability of sudden rule reinterpretation. Its absence increases optionality value. Optionality, in this context, does not require action. It requires preparedness. At the same time, U.S. exchanges continued operating under established assumptions regarding participation diversity. Open interest remained within historical ranges. Reported inventories showed no anomalous drawdowns. Delivery volumes remained manageable. From a purely statistical standpoint, no pressure was observable. This is consistent with early-stage structural divergence, where pressure exists not as force, but as constraint accumulation. The system still clears because participants have not yet been forced to choose between efficiency and autonomy. The administrative tone surrounding the termination reinforced this dynamic. Statements emphasized sovereignty, procedural independence, and the completion of contractual obligations. There was no language suggesting urgency or conflict. This framing matters because it delays behavioral adjustment. When actors are not compelled to react defensively, they instead adjust incrementally, reallocating risk at the margins. These marginal adjustments are rarely visible in aggregate data until they cross a threshold. Within the first 90 days following the termination, several observable but non-conclusive patterns emerged. Chinese commodity-related entities increased engagement with alternative pricing references in parallel markets. This did not involve formal withdrawal from U.S. exchanges. It involved diversification of reference points. Simultaneously, discussions around local settlement mechanisms and bilateral clearing arrangements gained renewed institutional attention. None of these developments violated existing frameworks. They operated alongside them. From the perspective of the U.S. commodity exchange system, these shifts register as background noise. Futures markets are accustomed to participant churn. Liquidity absorbs gradual changes. The architecture is built to handle diversity of intent. However, this resilience assumes that diversification does not become synchronization. Pressure becomes relevant not when participants explore alternatives, but when they do so in correlated fashion under shared constraints. At this stage, it is not possible to assert that such correlation has formed. What can be documented is that the removal of the agreement eliminates a stabilizing reference that previously reduced the incentive for correlated diversification. The system now relies more heavily on implicit trust and less on formal alignment. Implicit trust functions well until it is required to substitute for explicit guarantees. This brings the analysis to a structural question rather than an event-driven one. If a major industrial and reserve-holding economy incrementally reduces reliance on U.S.-centered commodity settlement frameworks without withdrawing from them, how does that affect systems designed around global participation? The question is not whether pressure exists today. It is whether the architecture can remain neutral to directional disengagement. At this point, methodological limits must be stated clearly. This analysis does not predict market outcomes, price movements, or institutional failure. It does not attribute intent or strategy beyond observable administrative actions. It does not assume coordination where none is documented. The scope is limited to structural compatibility between evolving trade relationships and existing commodity settlement systems. Returning to the terminated agreement, its most significant function may have been psychological rather than mechanical. It provided a shared procedural horizon. Its absence shortens that horizon. Shorter horizons increase the value of control over physical inputs and settlement paths. In commodity systems, control is exercised not through volume alone, but through delivery optionality and jurisdictional insulation. The continuation of normal operations following the termination should therefore be interpreted cautiously. Stability does not equal resolution. It indicates that reconciliation has not yet been forced. The system is still operating within tolerance bands established under previous assumptions. Those assumptions included a baseline of bilateral administrative cooperation that no longer exists in the same form. As time progresses, the effects of this change will not appear as sudden shocks. They will appear as preference shifts, preference for alternative delivery points, preference for non-dollar settlement in specific contexts, preference for contractual frameworks that minimize exposure to unilateral reinterpretation. Each preference individually is manageable. Collectively, they redefine the center of gravity. The commodity exchange system, including COMEX linked structures, is sensitive to center of gravity shifts not because of immediate liquidity concerns, but because of inventory representation. Registered inventories are a function of willingness to warehouse metal under specific jurisdictional conditions. If that willingness declines at the margin, inventory quality changes before inventory quantity does. This distinction is critical. Quantity can remain stable while availability under stress conditions deteriorates. In the current phase, no public data indicates acute stress. That is expected. Structural pressure rarely announces itself. It accumulates through mismatches between contractual expectations and strategic incentives. The termination of the agreement did not create those mismatches. It removed a mechanism that helped reconcile them. The central analytical question can now be stated explicitly. Can a commodity settlement system designed around open participation and jurisdictional trust remain structurally neutral when a major participant incrementally deprioritizes that jurisdiction without exiting it? This question reframes pressure not as attack or response, but as compatibility. Answering this question requires moving beyond the event itself and into historical patterns, structural models, and constraint mathematics. Those components will be developed in the subsequent sections. For now, the foundation is established. A documented administrative change has occurred. Markets have not reacted visibly. Stability persists. The absence of reaction is not evidence of irrelevance. It is the starting condition for deferred structural reconciliation. The historical context in which the current configuration operates did not emerge from a single negotiation cycle or bilateral arrangement. It is the product of layered institutional decisions that accumulated over decades, each one rational within its own time frame, yet collectively producing a system that depends on continuity more than balance. Commodity settlement systems, particularly those centered in the United States, expanded during a period when global trade integration and jurisdictional trust were converging rather than fragmenting. This convergence was not ideological, it was logistical. Standardization reduced friction, centralization reduced cost. Over time, these efficiencies hardened into assumptions. During the late 20th century, the integration of global manufacturing with dollar-denominated trade created a feedback loop. Industrial expansion increased demand for raw materials. Futures markets expanded to hedge that demand. The success of those markets reinforced the use of their pricing signals. This process gradually transformed exchanges from risk management tools into reference authorities. The authority was not formal, it emerged from repeated use. As long as participants accepted the neutrality of the system, its central position was reinforced. The entry of China into this framework followed the same logic. As manufacturing capacity scaled, access to stable pricing references and deep liquidity pools became operationally necessary. Participation in U.S.-centered commodity markets was not a concession. It was an efficiency choice. Over time, that participation extended beyond hedging into reserve behavior, inventory strategy, and procurement planning. The system functioned because incentives aligned. The cost of participation was lower than the cost of isolation. However, historical cycles show that alignment is not permanent. When trade relationships mature, the marginal benefit of dependence declines. At the same time, the marginal cost of exposure becomes more visible. This transition does not occur through confrontation. It occurs through internal recalibration. Institutions begin to ask whether inherited structures still optimize for current constraints. This question is structural, not political. Previous periods of commodity system realignment followed similar patterns. In the 1970s, shifts in energy settlement exposed the limits of existing arrangements. In the 1990s, the expansion of derivatives introduced complexity that outpaced regulatory coherence. In each case, systems continued operating while internal mismatches accumulated. Resolution came not through collapse, but through reconfiguration. The process was uneven and prolonged. In the current cycle, the reconfiguration pressure arises from scale and symmetry. China is no longer a marginal participant adapting to an external system. It is a system-scale actor whose internal demand, reserves, and production capacity rival the structures it interfaces with. When such an actor reassesses settlement pathways, the effect is not withdrawal, but duplication. Parallel mechanisms emerge. Redundancy becomes rational. This brings the analysis to the structural model. Commodity exchanges like COMEX operate on a layered representation of supply. There is total above-ground metal. There is deliverable metal. There is registered inventory. There is paper representation through futures and options. Each layer assumes convertibility under defined conditions. The system does not require full convertibility at all times. It requires confidence that convertibility would be honored if demanded. In early stages, diversification away from a dominant system affects only the outer layers. Paper positions remain. Hedging continues. What changes is the preference for where physical metal is stored, refined, and classified. This is the initial stage of structural divergence. It is largely invisible because reported inventory levels can remain unchanged. Metal can be held in different jurisdictions while still being counted within global supply estimates. As divergence progresses, the second stage involves contractual preference. Long-term supply agreements begin to reference alternative benchmarks. Settlement clauses include optionality for currency or delivery location. These adjustments are defensive rather than aggressive. They do not signal rejection. They signal hedging against systemic asymmetry. Importantly, they can coexist with continued participation in legacy markets. The third stage introduces friction. As more participants adopt similar hedging behavior, the dominant system experiences a change in participant composition. Liquidity remains, but the proportion of actors willing to stand for delivery under stress conditions declines. This does not reduce daily volume. It reduces resilience. The system becomes more efficient in normal conditions and more brittle in extreme ones. COMEX, as a pricing and settlement reference, is structurally sensitive to this stage. Its design assumes that only a small fraction of contracts will result in physical delivery. That assumption is valid as long as participants treat the contract primarily as a financial instrument. If a growing subset begins to treat it as a conditional claim on metal rather than a hedge, the balance shifts. The system can absorb this shift up to a point. Beyond that point, rule enforcement replaces trust as the stabilizing mechanism. The inevitability in this model does not arise from intent. It arises from arithmetic. A system with layered claims must maintain confidence that lower layers can support upper layers under defined scenarios. If a major participant incrementally reduces its reliance on that system for critical functions, the remaining participants inherit a larger share of that confidence burden. The system still works, but the distribution of risk changes. Historical analogs suggest that systems under such conditions tend to formalize previously implicit assumptions. Margin rules tighten, delivery requirements are clarified, eligible inventory definitions become more restrictive. These changes are presented as risk management improvements. Functionally, they are adaptations to reduced surplus trust. Each adaptation preserves stability in the short term while signaling structural adjustment in the long term. At this stage, it is important to emphasize that none of these dynamics imply imminent disruption. They describe a trajectory, not a timetable. Large systems adjust slowly because their primary objective is continuity. Pressure manifests as incremental rule refinement rather than abrupt failure. Observers expecting visible stress signals often misinterpret silence as resolution. The model also clarifies why bilateral agreements matter beyond their explicit clauses. They reduce uncertainty by aligning expectations. When such agreements lapse without replacement, uncertainty increases asymmetrically. Smaller participants adapt by following dominant signals. System-scale participants adapt by building redundancy. This asymmetry accelerates divergence because the largest actors have the capacity to absorb transition costs. From the perspective of US-centered commodity markets, this creates a paradox. The system benefits from global participation, yet its resilience depends on participants valuing it as a neutral intermediary rather than a jurisdictional extension. When neutrality is perceived as conditional, participation becomes tactical rather than structural. Tactical participation is more sensitive to external shocks. The historical context therefore frames the current situation not as a confrontation between China and the United States, but as a maturation point in global commodity infrastructure. As trade volumes, reserves, and industrial capacity concentrate, the incentive to internalize settlement functions increases. This is not a rejection of existing systems. It is an optimization under new constraints. The base mathematics of scarcity further reinforces this trajectory. Physical metal supply grows linearly, constrained by geology, energy, and refining capacity. Paper claims grow exponentially, constrained primarily by regulatory tolerance and risk appetite. The gap between these growth rates is manageable when trust is abundant. When trust becomes selective, the gap becomes a source of systemic tension. In the early stages, this tension is absorbed through netting and cash settlement. In later stages, it requires reclassification of what constitutes deliverable supply. This is where systems like COMEX face structural choices. They can adapt rules to preserve continuity, or they can rely on legacy assumptions until stress forces adjustment. Historically, adaptation precedes stress, but only after sufficient signals accumulate. The inevitability, then, is not collapse, but redefinition. The center of gravity shifts gradually. No single event causes it. The termination of the agreement is not the cause. It is a signal that alignment is no longer taken for granted. The system continues to function, but under evolving premises. This completes the structural and historical foundation. The next section will move into the quantitative layer, examining how scarcity mathematics and claim density interact with settlement architecture, and why certain constraints cannot be reconciled indefinitely, regardless of intent or policy. As the structural model advances into later stages, the distinction between adaptation and constraint becomes increasingly important. Systems designed for flexibility often discover that flexibility itself has limits imposed by physical inputs. Commodity settlement frameworks can adjust rules, redefine eligibility, and modify incentives, but they cannot manufacture underlying material abundance. This is where the mathematical layer becomes decisive, not as a prediction tool, but as a boundary condition. The base arithmetic of futures-based commodity systems is straightforward. A relatively small pool of physical inventory supports a much larger volume of contractual claims. This relationship is not inherently unstable. It is efficient under conditions where claims are rarely exercised simultaneously and where participants trust that settlement alternatives will be acceptable if exercised. The system relies on probability rather than fulfillment. Most contracts are closed financially. Delivery remains the exception. However, this efficiency assumes that the probability distribution of delivery demand remains thin-tailed. When structural incentives change, the distribution shifts. It does not require panic or coordination. It requires that more participants assign non-zero value to delivery optionality. Even a modest increase in delivery preference can alter system dynamics disproportionately. In the current configuration, COMEX-linked structures operate with defined categories of inventory: eligible, registered, and deliverable under specific conditions. These categories are administrative constructs layered onto physical reality. They function as long as classification aligns with participant expectations. When expectations change, classification becomes a point of friction. The mathematical constraint emerges when the ratio between open interest and readily deliverable inventory exceeds tolerance under stressed assumptions. This does not mean that delivery will be demanded. It means that confidence must compensate for the imbalance. Confidence, unlike metal, is not conserved. It must be continuously replenished through behavior, precedent, and perceived neutrality. As redundancy building accelerates among system-scale participants, the replenishment mechanism weakens asymmetrically. Smaller actors continue to rely on legacy systems because alternatives are costly. Larger actors reduce reliance because alternatives are feasible. The result is a system that remains liquid but becomes more internally concentrated in terms of delivery willingness. This concentration increases sensitivity to shocks without increasing their probability. At this stage, exchanges typically respond through procedural reinforcement. Delivery rules are clarified, force majeure clauses are revisited, cash settlement mechanisms are emphasized. None of these actions indicate failure. They indicate recognition of constraint. The system adapts to preserve continuity under narrower conditions. From a forward-looking perspective, the timeline that matters is not measured in days or quarters, but in administrative cycles. Each renewal of rules, each inventory audit, each margin adjustment reflects accumulated information. Over time, these adjustments map the system's tolerance envelope. Observers looking for dramatic events often miss this gradual recalibration. Several plausible scenarios coexist within this envelope. In one, diversification stabilizes at a level that preserves COMEX AS role as a dominant reference while reducing its exclusivity. In another, parallel pricing systems gain depth, reducing reliance on any single benchmark. In a third, stress events accelerate rule formalization, reinforcing the distinction between financial instruments and physical claims. None of these scenarios require confrontation. All are compatible with continued operation. Counterarguments must be addressed explicitly. One common objection is that U.S. commodity exchanges have weathered similar concerns before. This is accurate. However, previous cycles involved fragmentation among smaller participants, not redundancy building by system-scale actors. Scale changes the arithmetic. Another objection points to the adaptability of financial engineering. While true, engineering can redistribute risk, not eliminate physical constraints. It is also argued that as long as inventories are reported and audits continue, confidence will hold. Reporting, however, reflects classification, not compulsion. The question is not whether metal exists, but under what conditions it would be mobilized. That distinction becomes relevant only when incentives shift. Importantly, none of this analysis implies inevitability of disruption. It implies inevitability of adjustment. Systems that ignore arithmetic eventually reconcile with it through design changes rather than breakdowns. The reconciliation process is often interpreted as pressure from the outside. In reality, it is pressure from within the model itself. The termination of the agreement between China and the United States should therefore be understood not as a trigger, but as a marker. It marks a phase where alignment is no longer assumed and where optionality becomes strategically valuable. In such an environment, neutrality is tested not by rhetoric, but by architecture. The role of COMEX within this evolving landscape remains functional, but its function may become more specialized. Price discovery, hedging, and liquidity provision can persist even as physical settlement relevance narrows. This would represent not a failure, but a redefinition consistent with structural constraints. For observers, the appropriate stance is neither alarm nor dismissal. It is monitoring, watching how inventories are categorized, how delivery behavior evolves, how contracts are written, and how parallel systems mature provides more information than headline events. Structural change announces itself quietly. This analysis will continue to track these variables as they develop. The objective is not to forecast outcomes, but to document compatibility between physical reality and financial architecture as global trade relationships evolve. Systems endure not by resisting change, but by absorbing it within their limits.